Good morning, everybody, and welcome to the Daily Energy Markets Podcast. It is May 27th, closing out the month of May with oil prices essentially range bound, even in probably the tightest range bound we've seen in quite some time, maybe all year. I mean, through the first quarter, we saw a steady rise. $5 January, $5 February, $5 March, up above 90 at the beginning of this quarter, and it's been down, down, down through to sort of mid-May. But the last week or so, it's been nothing much happening. Perhaps everybody's waiting for Godot, the OPEC meeting due to take place in the coming days. Omar Najia, global head of derivatives at BB Energy. Your thoughts on the market outlook, sort of a flat line, stuck in this tight range. What will move it in either direction?
Well, no, I basically don't think it's flatlining. I mean, it depends on your perspective, right? If you want to look at it for a week or something, but I think we've corrected. We went up from 67 to 87, now from 87 to 77, plus or minus. There's a down channel that you could very clearly see from the highs at 87 down to where we are now, and we are just peaking above that line. If we can actually break that line, I mean, I don't want to show you, but I don't know if you can actually see. No, forget it. Okay, so basically, we're just about to we it is possible that we break above that line. If we break above that line, not just me, but everybody will see that, and the market is very short. So if we have a candle above that line, which comes in at about $78 today, so if we can print, not today because it's touching the line, but if we can clear 78 tomorrow and not touch it and have one candle above that line, then I think everybody and their friends are going to basically short cover, just short cover, not go long. And I think this market is going to be propelled considerably higher. So I'd look second half to go back above 87. Long term, we're looking for new all-time highs. We're very bullish. And the same pretty much about everything, whether it be, precious metals, Bitcoin, the S&P, all of it. So, and again, nothing that I see, I mean, wars, geopolitics, all that is inflationary, is bullish commodities. So wherever I look, I just see one story, which is, more liquidity, more money, more spending, and no kind of restraint, especially since we're in, US election cycle, and you're going to have elections in the UK and the rest of Europe. There's nobody who's going to get elected in the West that's going to come and say, look, elect me because I'm for austerity. I'm going to cut spending. I'm going to tax it to shit, and I'm going to take all your money. They're not going to get elected. The people who are going to get elected are people, I think, like Trump, who come in and say, cut taxes, do this, more spending, more this, et cetera, et cetera. So generally bullish and strategically bullish oil.
Brian Pieri, founding member of Energy Rogue, based in Denver, Colorado. Brian, one of the sort of pillars of this market has been the very disciplined OPEC supply cuts, now well above 6 million barrels a day. A lot of oil being forcibly kept off the market. What is the outlook for, we saw last year the US add a lot of barrels. You've always been good to update us on the outlook there, but also looking at Latin America, it seems that the Biden administration's sort of closing down the sanctions again in Venezuela. It looks a bit more like a fig leaf. It seems everybody's getting an exception there. Your thoughts on the outlook for the Americas, starting with the US, on adding enough barrels this year to spoil the OPEC plus party?
Okay, great. Thank you, Sean. Listen, I've been pretty consistent since last year. We're currently producing in the United States about 13.1 million barrels a day. That's actually the same level that we were producing in October. We're pretty much flatlined at the current rig rate. So the declines are kind of matching in tandem with new production that's being brought online. So we would need to see an expansion of rigs to really see more oil come to the market. And the economics are obviously up there with pricing being where it is. But one thing I would say before I move on to Venezuela is that if you look at the pricing today, roughly about 10 years ago, the price for Brent and WTI was about the same. And I recently talked to a Permian producer, and they said, well, I looked at AFE, which is basically the cost to drill. And from 10 years ago, it's up 300%, but we get the same price for oil. So costs are increasing. So operators are having a harder time bringing it on, which is part of the reason that you have rig discipline and they're not expanding as much as they were last year. Last year was pretty much still a catch-up year from COVID. So I still expect U.S. production to be flat or even less, probably 12 million barrels a day by year-end exit. I may be an outlier on that projection, but that's what I'm seeing. We are seeing some growth in Canada, and some of that is to satisfy some of the LNG output that they're going to have. So they're having some oil and some gas development up that way, but it's only a couple 100,000 barrels a day. Down in Venezuela, there has been kind of a re-implementation of the Venezuela sanctions. However, Chevron, Repsol, they're kind of exempt or allowed to continue their existing operations and development. So I don't see a near-term slowdown of what Venezuela is bringing online. That said, I haven't seen a rapid growth, and I still think it's going to take 24 months for the market to really see added barrels to the market. So that's kind of what I see from the Venezuela U.S. Side of the equation. Guyana, I'm still looking into that, but I expect some growth there as well.
So a few more barrels from the Americas, but nothing like last year, and probably not moving the dial too much on OPEC plus concern. Choib Boutamine, energy advisor and CEO of Rana Drill Consulting, based in Algeria. Choib, your thoughts? Obviously, Algeria, an OPEC plus country, a few days now ahead of the OPEC meeting. Just listening to Brian there and Omar. Is there anything other than a OPEC plus maintaining current policy that you think might be on the cards?
Yeah, good morning, Sean, and good morning, everybody. I think the OPEC as a group, as an organization, is planning to maintain at least the voluntary cuts. This is the first signs we are getting at the moment. But we have yesterday, one day or 2 days, a couple of days ago, we heard that Iran is putting a plan to increase its daily production to 4 million barrels per day. This is, I think, a surprising decision. Few hours only before the OPEC plus the meetings. So I think this is a unilateral decision by Iran. Really can affect the group this critical time, because if Iran is going to take this action in the upcoming few months, it will really create a split among the groups, and the organization. Yes, we agree. There is some illogic, I think, among the OPEC policy at the moment. This is my opinion. If we see the OPEC plus, the OPEC plans, it's saying that in 2024, the non-OPEC production will increase by 1 million barrels. But meantime, the OPEC plus is maintaining its cuts and voluntary cuts. At the moment, they are 5.86 million barrels per day. So if you have a market share is rising out of the organization, so logically, you have to increase, you have to pump more oil to the market, and at least you get part of the market share. So why do you leave that market share to the non-OPEC countries? So that's why I think Iran and even UAE is planning, I believe, in the upcoming months to increase its production. So this was creating an imbalance between the OPEC members. So some ones they have the capabilities. Iran has capabilities to increase. Iraq also, and UAE, all they have the capabilities to increase the production. But this is the big issue at the moment. I think they are discussing, and we have remarked that the meeting was planned for the 1st of June, but they postponed it to the 2nd of June. So I think that there is a split among the OPEC members, but I think in the upcoming future, they have to understand that the market needs more oil. So the UAE is saying 1.2, the OPEC is saying 2.2. I think this is a logic that demand is increasing, but they have to understand also to inject more oil to the market to protect the market share. So I think this is my opinion. And Iran, UAE, I believe they are going in this way. They say, okay, if you have market share, let's take parts of it. If not, somebody else will bridge the gap.
Omar, your thoughts on that? I mean, you've obviously have a bullish outlook on the markets in general, and the bullish second half of the year, 6 months. The idea that the demand for energy could grow, and a lot of forecasts that there's a tightening cycle into the second half around oil. Your thoughts on that creating an opportunity for OPEC Plus to start unwinding some of these cuts that are, of course, very expensive to maintain production capacity and not use it. Is there going to be a demand opportunity for them to unravel some of those cuts, do you think?
Okay, if you think about things simply, we like to think about things simply. You can, if you have a market, you can either increase or decrease market share, play with market share, or basically talk about revenues, right? So market share of OPEC can go up and down, but what is the market share of basically carbon zero? If the world is going to no oil by 2030 or 2035, it's zero. So if you ask me, if I'm in OPEC and I'm worried about market share, it's the least of my worries, absolutely least of my worries, because strategically you've said to me that my market share is going to zero. There's nothing I can do about it, right? So the only thing, in my opinion, that OPEC is going to worry about is maximizing profits. And it doesn't matter about basically, oh, they've got overcapacity here and there. It's exactly the same as the Fed, right? The Fed controls the markets, controls the US dollar, controls interest rates. It's not a rigged game because the Fed is controlling. It's just their job. In the same way, the price of oil, more than ever, is controlled as a base by OPEC. They want that price of oil to go higher. They don't care about market share. Makes no strategic sense to care about market share if that market share is going to zero. So we think that basically people are rational actors. Now, maybe, and by the way, I read a report, very interesting, that MBS is heading over to Iran, which hasn't been published in the Western
Mohammed bin
press.
Salman, the Crown Prince of Saudi Arabia, going on a state visit to Iran.
Yeah. So if that's true, I think it speaks of, there's a new shift, I believe. A shift basically which is BRICS against the rest. There's a shift in that basically major oil producers like Iran, UAE, Saudi Arabia are now part of the BRICS. So the US and the West are losing the ability to kind of control oil prices. If you think of Biden, the Biden administration, they pumped most of their SPR. They've done whatever it is to basically try and hold prices between now and November. I think that dam is about to break and you're going to see basically prices escalate. It's going to be very interesting to see what happens. But on a fundamental level, Brian was talking about the price of oil today being the same as 10 years ago. You tell me one thing in the price of nuts to the price of coffee that's the same as it was 10 years ago. And this is the most critical thing for the global and Western economy. All plastics, everything. I mean, Tesla couldn't function without petrochemicals. Nothing could. So the idea basically, for me, that yes, you know what, strategically, I'm going to sell oil because They're going to worry about market share and the price is going to go down and is demand 1 or 1.752 and any of that stuff. It goes out the window. Big picture is it's the cheapest it's been in 10 years. Everything else is inflating. Do I buy it or do I sell it? It's a no-brainer. You buy it. So that's our view. And we don't think market share is important if they tell you, like they have, that your market is going to zero, because we don't want to use oil anymore. We want to go green.
Brian, looking to the election cycle, obviously in the US, it's in November. It's, I'm sure, becoming very loud there. And it is election in Europe this week. The European Parliament elections are coming in the next week, and so on and so forth. But in terms of the US election, there's clearly probably one of the more important ones in the world, and the outlook as to what the difference might be between Biden and Trump. And it seems increasingly, as that gets studied and Trump sort of emerges in the polls, that not much is the answer. You know, the US oil and gas industry are pretty much doing as much as they can or are willing to do, except your thoughts on the difference not between oil and gas, whether there's more wind farms in Idaho, I don't know. But in terms of oil and gas coming out the ground and going to international markets, will there be much different between who's in the White House come next January?
You know, that's actually a great question. And I recently told somebody that I never really wanted to get into politics, and unfortunately I picked energy. So it drug me kicking and screaming into politics. So, but one of the things that I look at is, if you look at Biden and the Democrats, there are a lot of policies that are tilted towards renewables, and some of these policies are overarching. And one thing that we were discussing before we went live today was the fact that some of these policies actually could even prematurely shut in production of mature oil and gas wells up to 40 to 50% of the US production if these rules are taken very literally. So when you look at some of the policies that are coming through on the liberal side of the equation, they can have a little bit of a myopic view, because I think that's cutting the rope a little bit before they should. There's on the other side, you have the Republican and likely Trump, but you know, I mean, there's possibilities for all kinds of different things. On that side of the equation, there's probably a very friendly policy making. However, some of the friendly policy making would really have to go through a 2-year cycle of unwinding some of the things that have already been implemented. So it's not going to happen very quick, and nothing that happens in November will have an immediate impact in 2025. It's probably going to be an 18-month impact on the political side of the spectrum. But one of the disappointing things about the different political sides is that there's a fossil fuel debate and there's a renewable debate, and really the combination should be how they fit together, and that's what nobody is really focusing on. And I think that's the bigger problem. As a matter of fact, I recently talked with somebody that was responsible for all the power development in the United States, and they were looking at the fossil fuel development in the power stack, and they were saying, well, coal is going to drop off here and natural gas is going to drop off here. They had a 30-year model. And I asked a question whether or not that model was a daily model or an hourly model. And they said it's a daily model. And I said, well, you might want to look at the hourly, because you've actually just guaranteed coal in the power stack for the next 10 years because of it, because natural gas can't travel to the population centers fast enough, because when it gets cloudy, you know, for solar, or when it gets non-windy, we need to spin up, and there's really only 2 options that power plants have. It's natural gas or coal. And right now we've grown so much in development on the renewable side that the amount of megawatts that are needed, the amount of coal and natural gas that is needed to be spun up in 2 hours is exceeding pipeline capacity. So
Wow.
we have so much power development. So anyway,
Yeah,
sorry,
the electrification of everything sort of
Mhm.
puts all of these things under greater duress. Choib, you mentioned earlier in your comments there about other OPEC members who have been ramping up or looking to increase capacity and so forth. The African members of OPEC have been struggling to do so. We know for some time Nigeria has struggled to recover its production capacity. But what's the outlook in Algeria, in Libya, regarding further production capacity, investment in further production capacity?
Oh yeah, Sean. I believe that in African countries there is a big investment. I give you just an example: ExxonMobil and Chevron, Eni, and Total Energies are heavily investing in Africa. So I think that the new outlook at the moment, there is a smart investment in the oil and gas industry. There is a move to natural gas more than oil in Africa. And I'm talking also more about North African countries.
In the development or the consuming of?
Yeah, in the development, I'm talking about the development,
Right.
even about the local consumption, but the development of natural gas as it's part of the energy transition, because all we know that natural gas is emitting less than 60% of CO2 compared to coal. So many countries, many big majors are moving to invest in natural gas. And the good example I give you for this, ExxonMobil. ExxonMobil last October, we heard about the acquisition of Pioneer with I think $62 billion. But at the same time, many people criticizing ExxonMobil, why we are going to energy transition, but ExxonMobil is getting another oil company. But what ExxonMobil is doing is very smart. They acquired Pioneer with $63 billion. But meantime, they acquired Denbury. It's major company, small company, but has very long expertise in the carbon capture, CCS. It has the largest pipes of CO2 in the US. I think 1,300 miles of carbon pipes. And this company is investing a lot in carbon capture and EOR, enhanced oil recovery. And this is a very smart plan. So they get oil companies, but other side, they try to decrease the carbon emissions. So I think this is what a smart investment, I believe. And ExxonMobil has signed a few days ago a contract with a national company here in Algeria, Sonatrach, about natural gas, not about oil, to invest to develop the fields of natural gas. I think what's happening at the moment is ExxonMobil, for example, I'm talking about, we know that there is a gap of natural gas in Europe. So instead to invest in the US and extract natural gas, you have to liquefy it to minus 160 degrees, and you lose 15 or to 20% of energy, and you have to make more emissions when you transport your natural gas from the US through the ocean to the Europe. So what's the policy at the moment is to invest in the places very close to your market. So there is a gap in Europe. Algeria is very close to Europe. So you invest in Algeria, you extract natural gas, and we just transport it through the pipelines. So you don't need to liquefy your natural gas. So you save more than 15 to 20% of energy. You don't need to transport it for a long distance, and you lose and you pollute the environment with CO2 emissions. I think this is a very good plan for majors are doing at the moment. So Eni also is present in Algeria.
Well, we're certainly seeing that a lot of development opportunities there, both in the East Med of Egypt, obviously Algeria, and clearly more to come in terms of the supply. And as you say, on gas, let's go to the survey question and sort of pick a little bit of a focus as OPEC Plus sits to think about the second half of the year. They will be asking themselves this question: will oil supply demand market tightness in the second half allow OPEC to start unraveling cuts? Will there be enough? There's a lot of research by the major sort of research agencies saying that the second half will be very tight, and drawing down off of inventories if OPEC maintain current cuts. So there does seem to be a demand opportunity. Whether one wants to take it or not, and perhaps is the question there, and avail of that. As Omar says, it's not about market share, it's about dollars. So keep the oil locked in and let that price go up in the second half with the tightness. Omar, looking sort of immediately, and you had referenced it in your earlier comment, where we go on the resistance lines. We've seen the WTI close last week at 77, a little over $77, coming $10 from the high in early April. Is that now a resistance line, do you think? Or you mentioned earlier that looking at the line, it breaks through. I didn't quite understand that. What's the resistance line you're watching specifically? What's the price point of that?
Okay, so if you look at a continuation chart, not a month, not July, but if you look at a continuation chart of WTI, it went from, let's call it $67 back in I can't remember now.
67 back in
67
December
back in
12th.
December.
December 12th.
Yes, yeah, and it went and set a high at about $87, right?
Yes.
And from the $87, yeah, from the $87, we've come off and we've gone down to about $77, where we are now, plus or minus, right? So you can connect that high at 87 to the basically, if you do like a down channel from that high, you can see that the price today is actually touching that line. If you break that line, if you have a candle, technically speaking, a full daily candle above and not touching that line, that would indicate a trend change. Now, nothing in life is certain, but it's highly probable. If you see that, if I see that, if other people see that, they will buy purely on that signal, not to do with anything else. They will buy, meaning what? Some people will go long, other people will cover shorts, okay? And that should propel the market higher. In any case, we think that the move from 67 to 87 was part of an initial move upwards. The move from 87 to 77 was a correction. And now we're going to go from 77 up and eclipse that 87 high and go 90, 100, wherever the market's going to go. So if that line breaks sometime this week, then I think a lot of people will buy, a lot of people will short cover, and that should give like an impetus. Now, what will happen is maybe OPEC will say, oh, we're going to maintain cuts. And then you'll say, the price went up because OPEC said blah, blah, blah. But the price is going to go up because of that candle. Got nothing to do with what OPEC is saying or doesn't say. So let's see what happens.
Brian, last word for you. I wanted to get your, another piece of the tightness puzzle for OPEC Plus they'll be looking at, and hence meeting now, is whether the U.S. will have its, the driving season, as it's called. This is Memorial Weekend in the United States. Today is a holiday in the U.S. and in the U.K., a bank holiday for Memorial Day weekend. Are we seeing, is the outlook for a strong driving season?
So I was just looking at that because we actually track diesel, gasoline, and what's interesting is when you look at the relationship or the interrelationship between diesel and gasoline, there's some interesting things happening. Number one, in several parts of the country, gasoline and diesel prices are actually the same right now. That is very rare and a big change from last 24 months.
You're saying on the per gallon basis?
That's correct, on the per gallon basis, because diesel right after COVID went to one of the widest spreads that we've ever seen versus gasoline. So there's an indication there of two things that could be happening on the driving season. One is there's more gasoline demand. In other words, gasoline and diesel. Diesel should hold a premium to gasoline. So gasoline, it means one of two things. Either gasoline is having good underlying demand or diesel is having soft demand. And both of those indicate two different things. Gasoline would be a high consumer-based consumption, but diesel, if we have soft diesel, that could be an underlying weakness on economy, which could have much more broader impacts and could be a canary in the gold mine. So in the coal mine, not gold mine.
Could be a gold mine too. It's
Yeah, it could be.
Colorado.
Yeah, it could be. But so I see those two things. So I'm not giving you a clear bull bear, but I'm seeing conflicting things, and one of them could be a positive driving season. However, the diesel is far more concerning when I come to the underlying economy, and that's what I'm going to be watching recently or in the coming weeks.
Well, certainly after this big weekend, the data that usually emerges after the Memorial Day weekend sort of sets the tone. There we have the survey results. Split room, always like that when the room is split on the outlook for things. We'll post that on social media and see if there's consensus there. Brent crude oil trading, little change this morning in Asia, up about 1/3% at 82.35. We'll see how the week goes. The last week was a somewhat soft to bearish week, but there's been a lot of sort of holding fire until OPEC sort of puts forward its clear idea for the second half of the year. And once it does, then this market might find some direction. We saw news overnight, the chief economist of the ECB, the European Central Bank, indicating that the ECB was now ready for cuts. So that could be another impetus for the markets if the Fed was to sort of align with the euro outlook and cut in the next June meeting. We'll see on that. So a few things to keep an eye on. But for now, thank you so much, Omar Najia in Dubai, Brian Pieri in Colorado, and Shoaib Boutamin in Algeria. Great to kick off the week with such an international bunch from all corners of the world. It's what makes the Daily Energy Markets podcast so special. Thank you, guys. Have a great week. All the best.
Thanks so
Thank
much.
you.
Thank you. Have a
Thank
good
you.
day.